Welcome to Daily Crypto News. I'm Sarah, and this is another episode where I invite the industry expert to talk about the topics that matter, but maybe not talked about that much. Today we have John. He is the founder and CEO of Caladan, a crypto native VC firm and market maker. He has a vast experience in crypto and also AI investment. So I would love to hear his thought on the restaking era. I know we have a summer and it might be a little um, not such a good news, but I think it's very important to address this risk and how it's going to form and landscape in the future. So, John, welcome.
Yeah, thanks. Good to be here.
I would love to hear you about your experience, who you are, for those who don't know yet about yourself.
Yeah, sure. I guess background was that I studied computer science back in the day. I guess computer scientist by training, and I got into finance as kind of an accident. I ended up working with a professor of finance who did a lot of cross-disciplinary work, and he often worked with students from other industries. And so I happened to have him as my thesis advisor for my master's degree.
Mm,
And then he also happened to be running a quantitative hedge fund at the time. So he asked me to interview, and I did, and ended up getting an offer and worked there. So really enjoyed it, and eventually, because of my computer science background, I started getting more and more interested in algorithmic high frequency trading.
right.
So ended up kind of steering my career in that direction.
Mm,
Um, and so that's kind of what led me to ultimately looking at the opportunities within crypto. Yeah, my parents were entrepreneurs. I left my job in 2016, thought I wanted to start my own business, but had no idea what I wanted to do. Um, and then a friend clued me into, hey, crypto is quite inefficient. You might want to take a look at it. And so I did, and then here we are. So it's quite lucky and quite good. I should think fortunate in terms of timing.
right, right. I see that background being very useful. Computer science is, I mean, I guess it's closely related to development, software, hardware, and I think we need more people like that in the industry. And also interesting that you ended up actually running a fund instead of joining a hedge fund, like you said, or other investment firm.
Mhm. Yeah, right. So I was working at so before founding Caladan, I was working at a place called Tower Research, which is a large algorithmic high frequency trading firm.
Right.
Um, my parents immigrated to the U.S. when I was young, and they ended up founding their own business. It's a healthcare IT business, and I sort of grew up watching them do it, and so I
Uh-huh.
was always inspired to sort of be an entrepreneur of sorts. And in 2016, I thought that was the right time. I had been, reasonably lucky in my career to be financially independent enough to take the risk, and so
Hmm.
I left my job. So it wasn't. I wasn't intending to go back to work for someone else. And getting into crypto, like I said, a friend told me about the markets and said, "Hey, it's getting quite inefficient." At that point, there was also the first ICO boom, so a lot of different
Right.
tokens that can be traded.
Hmm.
So I built some strategies that just ended up working much better than I thought they would. And that became a like a natural start to the business, and we just kind
Right.
of took it and ran with it.
Right. I would love to invite you again if there is any big news coming from Caladan, but today I want to stick to the topic that I heard when I first met you, and it's about staking derivative in Ethereum. And
Mhm.
would you mind telling us what maybe the staking derivatives that is extinct in crypto?
Yeah. So maybe we start with what a derivative is, right?
Yeah.
A derivative, as the word implies, kind of derives its value from something else.
Yeah.
And this allows you to sort of more efficiently trade and exchange risk. So common derivative products that exist in traditional finance are things like futures, options. I think people would hear terms like interest rate swaps or credit default swaps. But all of these products derive their value from something else.
Mm.
So I think within crypto, you obviously have the perpetuals, and you have options on BTC and ETH, and those are derivative products. But I think in this case, you're probably referring to the derivative label as applied to things like liquid staking, right, or what people call liquid
Yes.
staking tokens and derivatives.
Mm-hmm.
Yeah. So I guess. So I guess maybe aside from whether or not we call them derivatives, it might make sense to sort of look at what they enable.
Mm.
And I think, if you look into traditional finance, there's this thing called fractional reserve banking. So,
Mm.
so the way it works is you sort of put $100 of deposit into a bank, they take $90 of that and loan it out to someone else. That someone else takes that $90 and presumably does something with it, but put a portion of it into another bank. And that bank suddenly has $80 that it can loan out. And
Right.
so with $100 of deposit, you have a lot more dollars in the system that's being put to work.
Yep.
So this increases leverage within the system, and it's by design. And it also increases this risk of contagion, which is
Mm.
what happens if that original $100 wants to pull the money. Suddenly, you have this unwind of this whole system that happens. And so, whether you call that a derivative or not, you sort of have this increase of leverage and increase of potential contagion risk. And so, when you sort of look at what restaking does, it does take the same asset and reuse it for different and potentially multiple purposes.
Mm-hmm.
And so I think it definitely has some of the same features of increasing leverage, and possibly contagion risk within the
Right.
system.
Right. That's actually the very important part of the derivative that I started to think. And immediately, and don't mind me, I will just get to the point. Immediately when I heard about, maybe not so much in the LST, the liquid staking tokens, but when I started to hear about the liquid restaking tokens,
Mhm.
that just associated me with the the time that we had a market crash in 2008, and it was just, aren't we going a little bit too much on putting products on top of products, whereby still we do have the underlying asset in the very beginning of the stake ETH, but ETH is also not immune to everything. So
Mhm.
we're only hyped in the bull market, and obviously insurance and the risk is not really well accepted in the bull market. But I thought it would be worthwhile talking about that. What kind of risk are we talking about in terms of making this derivative on top of staking?
Right, right. Um, so maybe we tease that out a bit and we think about the layers of risk.
Yes.
So at the very bottom layer right now, I guess you sort of have you just hold ETH, right?
Yep.
And that has sort of simple risks like maybe you lose your private key and you can't access the ETH, or you sort of have counterparty risk to an exchange where you're holding your ETH,
Mm-hmm.
or a validator. Um, and then you sort of you can stake that. So let's call that the layer one risk, and staking that. I think it's sort of ever since the move to proof of stake, there has been. I think the systems have been quite robust in Ethereum so far, but the risks there are sort of penalties, right? If
Mm.
you sort of delegate your Ethereum to a validator that goes down, it might incur some penalties. You
Sure.
run the risk of slashing.
Mm-hmm.
But again, so far, at least empirically, that hasn't turned out to be a huge risk, and the system have been robust.
Mm-hmm.
A layer on top of that is this idea of liquid staking tokens,
Right.
which you can take these, you have Lido ETH, ST ETH, you have Rocket Pool ETH. So
Mm.
essentially, it's kind of a IOU issued by these large staking firms.
Yep.
And the idea is that you might be able to use them for something else, right? You might be able to use them to trade or to put into a borrow lending pool or a swap pool and earn additional income that way.
Mm-hmm.
So the LST layer is probably sitting side by side with what EigenLayer is trying to do. So EigenLayer is saying, hey, you can take these liquid staking tokens and put them with us. And what we will do is we will take them and help to ensure crypto economic security, or essentially we can use them to help secure other applications built on top of Ethereum. And so within the eigenlayer construct, I think there are these operators who can then additionally issue what are called liquid restaking tokens, which
Yep.
are further fragmented because the fungibility within eigenlayer is a bit different depending on which set of AVSs, actively validated services, you decide to participate in. So not everything's fungible with each other.
Mm-hmm.
And so basically you have, I think, these 3 or 4 layers of risk. The danger, I think, is that the risk kind of cascades from the base upward, right? So if anything happens at the validator level that blows up, everything on top and all the assumptions that they're building on is violated.
Mm-hmm.
And so, like you said, it gets really risky at the liquid restaking token layer. Now, what's interesting is that, and this is the hard part to reason about, if that part gets really big, and it hasn't yet, right? I think there's a lot of talk about it, but fundamentally there's
Right.
very little use. It has a few effects. One is that it has a tail wagging the dog effect in that it makes it, let's suppose the LRTs get huge use, a lot of TVL using them.
Mm-hmm.
What's interesting is that you can't reason about the eigenlayer and the sort of attack. It basically makes for a larger incentive to attack that layer, not because the attack in itself is profitable, but because of its effect on the downward layer. So it kind of creates a bigger attack surface or incentive to attack the layer below it. Um, and then, of course, associated with that is if anything happens in that layer, the eigen layer, then the LRTs are invalidated to some degree, right? Um, so I think and as that layer grows, if it grows, it becomes quite difficult to reason about because things are connected in a very intricate way.
Yes.
Um, so that's kind of how I think about the risks. I think it is worth making a distinction between idiosyncratic risk
Mm-hmm.
and systemic risk. Idiosyncratic risk is like if I overlever and I get liquidated on an LRT, it doesn't matter, right? Someone else
Right.
takes control of it
Right.
and it doesn't affect the system. The
Mm-hmm.
issue is if there's a large enough base that somehow it introduces correlation or contagion or systemic risk. That's probably the more important one to focus on.
Mm. You mentioned two different types of risk. Uh, but the first risk, the idiosyncratic risk, is something that I don't think we have necessarily. There is no safety net in terms of that. Maybe because the type of the product that we're creating, I'm not sure. But systemic risk is somewhat protected in my opinion, because maybe that is like a fundamental risk that we are aware of in even without thinking about restaking or liquid staking. But if this becomes a compounded risk, does it what kind of situation can we even imagine? Is it even possible to imagine, or is it just a crash of all assets just losing values?
Right. So I think there do exist idiosyncratic risk. They just don't threaten the system.
Right.
So one idiosyncratic risk might be something like, well, I put my liquid staking tokens into Aave, and then some liquidity event happens, and that causes a set of liquidations
Right.
for my STETH. And that doesn't really affect the security of
Mm-hmm.
Ethereum because it's just that some people who assumed certain things about depegging events made the wrong assumption, they lost money, and someone else now took possession of that STETH. And but it doesn't affect the underlying security of Ethereum.
Yeah.
Right. So that's kind of the idiosyncratic risk. Now, what could happen, what's a systemic risk might be, and I'll play this out, is like ST ETH becomes so big, right, that there's such a large borrow and loan pool. People could say, if we were only able to hack Lido or put out some news piece about it or do something else that, forces a depeg in some way, then I could make a lot of money, even though the endeavor of hacking itself is not economically profitable. The sort of positioning outside of it is economically profitable.
Right.
So that kind of introduces a potential systemic risk. So normally we think of risk traveling, from the foundations upward, right? Obviously, if Lido sort of blew up in some way, everything built on top of it would just go kaput. But we don't really think about how it kind of percolates back down, or it's harder to think about that. I wouldn't say we don't think about it, but it's harder to think about it. It's the same sort of economic incentive for people to, I think, basically Oracle attacks are similar, right? Where you can manipulate the underlying market because there's a bigger derivative market tied to the underlying, where you can make your money there, and lose money on the manipulation itself. So this is sort of the incentives that you're putting in place.
Right. The intricacy of these layers and how different platforms work. Of course, I'm not an expert, so I wouldn't be confident to know that how every single layer works. But I could easily imagine that if there is some sort of volatility, maybe bigger than usual, in the market happening, then something similar to bank run could happen. So all of the top layers start to people start to move out their funds, and then the restaking or liquid staking rewards, which is supposed to be on top of the yield that people get, will no longer exist. And then those platforms start to crash, and then would it mean that still the staked ETH are somewhat in a safe situation, or would that be leading up to, or is it even possible to leading up to the whole danger in the Ethereum system itself? Because it is, at the end of the day, now we are already using the proof of stake system in Ethereum.
Yeah. So if this was very easy to reason about, I think people would have highlighted the risk. What tends to happen though is that risks that appear uncorrelated in times of stress become correlated. So and often the mechanism of that correlation tends to be liquidity. Right. So, I think back in 2007 or 2008, you kind of had this quant crisis where a lot of quant funds started to see losses that were just sort of really they've never experienced before, and all of their signals were going the wrong way that were uncorrelated in the past. And the reason is because I think basically there was a forced unwind, and that unwind pushed all of these signals to sort of behave in the same way. So I think that's certainly a danger to pay attention to. But in terms of the things right now, there's nothing immediately obvious to me where if you say, hey, eigenlayer blows up, that affects the validator layer.
Right.
Except potentially, let me think. So there's different ways that eigenlayer works. And I don't know that all the details have been flushed out, or perhaps I don't know all the details. But there's a way for validators to participate directly. And then there's a way to sort of take the LSTs and stake it into eigenlayer. And how the mechanisms of slashing, I think, works might be different depending on what you do. So I couldn't really find a ton of information about it. But depending on how slashing happens, that could affect the base layer. But again, this is quite speculative at this point.
Yep, yep, totally understandable. Um, then how about we see how we can maybe mitigate this list risk? Is there only way, which is we don't use these protocols, liquid protocols, or is there any way for us to mitigate somehow? And I shared you a talk that Vitalik Buterin had in March about the rainbow staking, and
Mm.
I have to admit that I am not so technologically educated to understand how this could be a potential solution.
Yeah. So rainbow staking actually is something different, as I understand it. It addresses the risk of concentration at the validator level. So I think when he was talking about it, Lido was a very large percentage of the market, like 60% or
Mm-hmm.
something, and there was basically this fear that if you have such a large concentration of validators, or such a large concentration in a single validator, that can be a security threat or destabilize the decentralized nature of Ethereum.
Mm-hmm.
What we see today, though, is I think last time I looked, or there was some news about how Lido has dropped below 30%. And then Coinbase has come up, and you sort of have this longer tail. It's a healthier ecosystem of validators.
Mm-hmm.
I think what he was trying to address was this idea that it takes some knowledge and effort to set up a validator, right?
Right.
It's not just that you have to have the 32 ETH. And so what that pushes a lot of people to do without that knowledge is like, I have crypto, I'll just delegate it.
Right.
Um, and so, and given what was happening at the time, people feared that there would be an overconcentration. When I sort of look at, and so you can definitely design around it,
Mm.
but when you sort of look at validator services, I don't think there's an inherent network effect there such that you have kind of a winner take all or a very like power law outcome,
Right.
right?
Right.
It seems like beyond a certain critical threshold, you can have a very diverse and healthy ecosystem.
Mm-hmm.
So whether you need rainbow staking at all is a separate question.
Right.
But you don't. I don't think that it directly relates to what we're talking about. In terms of what we're talking about, if you think about a pyramid of risks, I think it's exactly that. You want to build things like a pyramid, that the base layer is bigger than the layer above it, and that each layer above it is sort of smaller and smaller.
Mm-hmm.
And I think the danger comes potentially when it looks like a mushroom, where the base layer is small and then you have this big thing that's built on top and it's easier to topple over.
Yeah.
Um, so as it exists, I think people are talking about it more. And like I said, in reality, I think there's a lot more talk than product yet. So people have talked about LRTs, but they haven't yet been used much. And I think it is a credit that the EigenLayer team has been quite deliberate in how they're rolling out things.
Mm.
So I think there's a lot of hype, but the hype may not be from the builders themselves. So
Mm.
so we have yet to see the risks manifest through actual TVL products,
Yeah.
of LRTs.
Mm-hmm. Mm-hmm. Even maybe one silver lining, at least for me, is that even with all the hype and it sounds like Eigenlayer is almost dominating the market, but still, and if even though they are growing really fast and aggressively, still Lido has significant dominance in the market. So like you said, maybe it's not yet there in terms of solid product out of LRT, the liquid restaking, just yet for us to even discuss further. Um, mhm.
Yeah. I think that's right. I think the Lido risk where they're very concentrated has been mitigated a bit
Right.
in recent days. Just naturally, they're losing market share. Other players are gaining market share,
Mhm.
and then Eigenlayer, I think there's still very few actively validated services, and I think they're being deliberate about rolling out, and sort of testing their product. I think there will be inevitably bugs,
Mhm.
inevitably issues that are unanticipated.
Right.
Ultimately, though, it's I think every innovation has a sense of risk, right? It's just about being level-headed in assessing that risk. And I think crypto, because of the lack of speed, basically speed bumps, it tends to sort of really rush into things and sort of accentuate booms and busts.
Yep.
So I think here it's just about, it's just about trying to learn from previous mistakes that we've made, and being a bit more, I think, careful
Right.
in terms of how we use these sort of successive abstractions of the liquid restaking tokens on top of eigenlayer, on top of sort of LSTs, on top of validators.
Right. If I could zoom out quite a bit and see the landscape of the blockchain industry, we're very much focused on still Ethereum, and we're just even starting to see if we can use Bitcoin blockchain network for something else than just producing Bitcoin.
Mm-hmm.
Would you say that this industry as a whole could have something else than Ethereum? I mean, there are a lot of layer one blockchains. Not to offend them, but maybe technologically or even the proofing system can be adjusted or improved, or is there any other way for the blockchain industry to kind of live beyond what we already have? Maybe it's a big question, but I hope I could get some insight as you are also investing in various sector.
Mm, right. So I think so I think originally the idea of Bitcoin was that it's a stable asset or it's a sound money,
Hmm.
right? That was the original point. And then Ethereum came along and said, hey, we can do distributed computing, right? A decentralized computer. Um, so I think basically the vision of what blockchain is, and what it enables definitely kind of evolves over time. Like one of the biggest use cases today is actually stable coins, right? Because I think there's a hunger in the world for access to US dollars, and stable coins kind of enable that. But if you sort of take a step back, it's kind of ironic that one of the most successful use cases is pegged to fiat
Hmm.
when the original use case is about not being tied to any fiat system.
Yep.
Um, so um, I think if you look at just the use cases today, a lot of it is enabling trading and ultimately speculation of one sort or another.
Mm.
Which is not to say that is bad. I think casinos exist for a reason, right? They're a form of entertainment. So there's definitely value there, but there's a lot of infrastructure build which is ahead of actual use cases that may potentially fill that infrastructure.
Hmm.
Um, what the use cases are that we eventually discover, I think, is an open question. I have some confidence that we will find them. This is reminiscent of the telecom build out in the 2000s, where like, what are we going to do with all that bandwidth? And it just seems way more than we need. And lo and behold, today it's like, hey, we're actually really happy that got built
Yes.
out.
Yes.
So I think you have a few different use cases, and it makes sense to think in terms of a system of use cases rather than a single one,
Uh-huh.
right? So Bitcoin, for example, one of the excitement over the layer 2 networks is, what do you do with Bitcoin aside from holding it?
Right.
Can you make it a productive asset,
Hmm.
um, outside of it just sort of being like digital gold?
Mm.
Um, and the layer twos aim to try to make that asset a productive one, much like Eigenlayers is trying to make ETH more productive beyond just staking.
Right.
So I don't know if that answers your question, but it's a bit of some of my thoughts.
Yeah, yeah. I mean, I personally have been kind of even from the beginning of this year doubting myself, because that was end but beginning of the new bull market, and I was even thinking, okay, maybe I should leave this industry. It's not getting anywhere. So
Right, right.
it's always good to be assured or inspired by other people like you to just share some positivity, I would say.
Yeah, and it is kind of amazing in some way that you have, you sort of look at Uniswap, or you have these systems that just run,
Hmm.
and 24/7 people can swap and trade right now. And this is outside of any organized exchange, or and so that's pretty cool. I think it's sort of an illustration of what's possible.
Hmm.
I think one of the challenges that everything's financialized, right? So um, and that has its own downsides. And we're trying to figure out how to manage
Yeah.
it. But I think someone mentioned that the good thing about crypto is it's like an economist's dream. You kind of have this relatively isolated system that, until recently, do not affect the traditional financial markets. Like if crypto went away, it wouldn't probably impact, I think, the overall economy of the world that much.
Right.
But you have these experiments being run with real
Right.
money, real assets, really people, how interact with, real people interacting with real systems,
Right.
and you stand to learn a lot from it. And we're in that learning process.
Wow. Yeah.
So I think you get value out of that.
Totally. I'm getting like real time goosebump hearing this, because I don't know who that economist is, but I could not agree more. That is probably the one thing I would say if somebody asked me like, why are you in crypto? Then I would say that it's such fascinating thing to see. Um, maybe I'm going too grand, but like human being just experimenting on money. How when do
Right.
we do that? When is the last time since we invented money? Which
Right.
is very, very interesting, and we have a little society that, like you mentioned, it's not affecting the real one just yet, but and yet we're having this real time experiment and kind of pushing the boundary to see if this concept of money works, other than the one that we already have.
Yes. Yeah. Money, and then how to incentivize behavior in a distributed way.
Right.
So basically, a lot of what crypto enables, I think, are experiments in incentive design and coordination, distributed coordination of human behavior.
Right. Right. Thank you so much. This is so far much as I have prepared today. Do you have anything that maybe you would like to share before we go?
No. I think we talked about a bit of my background, maybe just a little bit on our firm, and how it's sort of grown over the past few years. I think we started out as algorithmic high frequency trading mostly on centralized exchanges. But when DeFi came about in 2020, we were one of the early ones to trade there. We were a launch partner for Compound. Um, and in 2023, we started getting into venture investing, as you mentioned, with just our own capital, as well as working with projects to bring liquidity and token market making. Yeah, and today we're very excited. We're building out an OTC business, both in spot and options. And so the business has grown, and I think, like I said, we've been very lucky. Um,
Wow, my favorite DeFi protocol and the first generation of protocol Compound, and I didn't know that it was a launch partner of yours.
yeah. We got in touch with them early,
Right.
and they were just one of the first real use cases, I think.
My, okay, okay. I believe that there are a ton of other things that we can tap on. If you have time, then I would love to invite you another episode in DCN.
Sure, sounds great. Thanks,
All
Sarah.
right. That's all for today. I hope you enjoyed and learned something with me at Daily Crypto News, and we'll come back with another episode. All right. Bye
Bye bye.
bye.